DBS has given an economic forecast on the Indonesian economy this year. Here are some of the important points. First, the domestic demand story is still intact. GDP growth is expected to reach around 6.3% and 6.5% in 2013 and 2014, respectively. Second, the current account deficit should narrow this year on the back of an improvement in exports and modest credit tightening. Third, Bank of Indonesia is unlikely to favor further rupiah weakness to facilitate the current account deficit adjustment, especially with inflationary pressures rising. Fourth quarter GDP growth reached 6.1% year-on-year, taking full year 2012 growth to 6.2%. Although headline growth is slightly slower compared to the 6.5% registered in 2011, the overall GDP growth number does point to resilience in the domestic economy despite significant external headwinds. In fact, domestic private sector performance was stronger in 2012 compared to 2011. Notably, private consumption growth and investment growth reached 5.3% and 9.8% respectively in 2012, compared to 4.8% and 8.8% respectively in 2011. The overall economic slowdown was due in large part to net exports, which took away 1.3 percentage points from headline growth. Going forward, external headwinds should become tailwinds amid stabilization in the major economies and a turnaround in China. Aside from an expected increase in external demand, commodity prices should become more favorable, reducing concerns on external funding. Domestically, growth momentum remains strong even if there have been some signs of softening on the investment front. Inflation is going to be a concern down the line, and the Central Bank or Bank of Indonesia may embark on modest tightening to reduce price pressures and further reassure on external imbalances. GDP growth is expected to reach 6.3% and 6.5% in 2013 and 2014, respectively. The strength of the domestic economy relative to the rest of the world has placed some stress on the external accounts. Last year, the current account deficit widened to $7.7 billion in the fourth quarter from $3.1 billion in the first quarter. The economy also registered the first full-year current account deficit since the Asian financial crisis, amounting to 2.7% of GDP. Cyclical factors have contributed to depressed commodity prices, while continued investment-led growth resulted in an increase in capital goods imports. Accordingly, almost the entire shift in the current account surplus in 2011 to a deficit in 2012 was due to the deterioration in the trade balance. Domestically, a further adjustment in the current account is likely to take place through higher interest rates and/or further macroprudential measures aimed at tightening loan growth. Externally, a moderate bounce in the commodity prices will help lift exports. DBS expects an uneven return to surplus in the trade balance in the coming months, thereby cutting down the current account deficit to 1.5% of GDP in 2013. Price pressures are building amid a robust domestic economy and are starting to be reflected in the inflation numbers. Inflation came in at 5.3% year-on-year in February, the highest level in 20 months, as food prices stay elevated due to floods that took place in January. Higher electricity tariffs also contribute to the higher inflation rate. Moreover, rupiah weakness is likely to lead to higher imported inflation, highlighting Bank of Indonesia's dilemma as it grapples with a widening current account deficit. Notably, the January inflation figure is already at the higher end of Bank of Indonesia's inflation target range of 3.5 to 5.5%. Increased vigilance towards price pressures are likely this year, and DBS expects a modest increase in the FASBI deposit rate in the coming quarters. DBS has recently revised up its inflation forecast for 2013 to 5.3% from 4.9% previously. This projection is contingent on the government staying pat on subsidized fuel prices.